and welcome. We are very excited for the next hour. For those of you who are attending live today, thank you for being here. We hope you will participate and ask questions of our guests. You can do that by clicking on the Q&A section below. And if you are watching a replay of today's episode, please be sure to register for the upcoming event so that you can attend it live and participate. We do have a special announcement to make today. Bill Beimel and his team will be returning with 2 more webinars before the end of the year. The first one will be on October 27th, and the second will be on December 8th. So please put those on your calendars and stay tuned for more details. But to today's presentation, the topic of today is rising defaults create opportunity for distressed debt buyers. It's a continuation of our series, Finding Safe, Opportunistic Investments in Times of Turmoil. The episode today is extremely timely as many of our viewers have expressed their desire for early insight into the economic effects of the COVID-19 virus. The residential mortgage loan data that you will see today from Andy Walden is the most up-to-date perspective on mortgage delinquency, and the perspectives of our panel of real estate experts will hopefully educate and guide your business or investing plans as we head into the fourth quarter of 2020. You can see a quick review of today's agenda on your screen now. After my introduction, Bill Beimel will take a few minutes to explain his firm's investment paradigm. Then our special presentation from Black Knight financial economist Andy Walden. We'll go ahead. And then after Andy's presentation, Bill will moderate as our panel of experts discuss the numbers and take your questions. Please be sure to ask questions now and ask your questions as they arise. There's no need to wait until the last 10 minutes of the presentation to get your questions out. All questions will be answered either verbally or in the Q&A chat box, so click below at any time throughout the next hour and post your questions. We have an amazing group of the hardest working professionals in the mortgage and real estate world here with us. These gentlemen are coming to us today from all ends of the United States. Tsukiyama is the Executive Vice President and Portfolio Manager with Spurs Capital, LLC, a New York-based investment firm specializing in sub-performing residential mortgage loans. Kai has also an 18-year record in real estate finance and has overseen platforms at several of the most affluent firms in the residential mortgage space. Harris Howard will also join us as the founder and managing partner at Howard Law Group based in Boca Raton, Florida. He represents primarily loan servicers and investors in the default mortgage space. As a boutique litigation and bankruptcy firm, Howard Law Group places heavy focus on lawyer-to-client communication, which can lead to quick and efficient legal results. Also, we have Ari Meltzer. He's the principal in First Lien Capital LP and the managing member of Service First Management LLC. He is a partner in several multifamily residential and mixed-use projects throughout South Florida. And Andy Walden, our featured speaker today, he is the economist and director of market research, data and analytics for Black Knight Financial Services, a premier provider of integrated software and data analytics to the mortgage and real estate industries. As the chair of Black Knight's editorial board and the guiding force behind Black Knight's Mortgage Monitor report, Andy is widely cited by media outlets and industry publications. And then when not giving lectures or interviews around the nation, Andy makes his home outside of Denver, Colorado. Fantastic place. And finally, of course, Bill Beimel. He is the managing director at Spurs Capital, LLC, and principal in First Lien Capital LP. Over his 2-decade career in real estate and mortgage finance, Bill has acted as a principal or advisor in more than $1 billion of residential and commercial real estate transactions. His expertise in loan loss mitigation was the driving force behind Bill's transition into the NPL management. And in 2017, he literally wrote the book on this strategy, Win-Win Revolution, an insider's guide to investing in the secondary mortgage market. Bill has recently relocated to Los Angeles, California. So good morning, Bill.
Morning, Merrick.
Good.
Great. Thank you so much.
Of course. And, I guess without further delay, Bill, take the conversation. Take it away, sir.
Thank you so much, Merrick. And I appreciate all of you that are attending live here today. My name is Bill Beimel. I'm a managing director with Spurs Capital and First Lien Capital LP. We are very excited by our main guest speaker today and the discussion I expect that will evolve as a result of Andy's presentation. Before we get to Andy, I just wanted to introduce a little bit about what my company does, our background, and our expertise in the mortgage and real estate world. First Lien Capital is a new closed-end fund we have just founded this year as a result of the major economic shift that is taking place in this country right now. Some of the data you will see today is quite alarming. There are several 100,000 mortgages going into default and several million that are in forbearance with an unknown result on the horizon. My team has worked in the residential mortgage space for well over a decade together. We have offices in New York, California, Florida, and Colorado. We've placed close to $1 billion of equity dollars in the whole loan trading business. Our roots come out of whole loan trading back before the last financial crisis. And my partners and I got together around 2008 and saw two areas of the mortgage and real estate world that were ripe to find arbitrage in. And the first being our connections in the secondary mortgage market, our ability to be a liquidity provider to banks and institutional investors in non-performing, sub-performing mortgages. And the second aspect that we specialize in is communication with the borrowers, overseeing our servicers and being a lifeboat to borrowers. And the key being communication, proper communication with the borrowers, listening to their needs, and having the flexibility as private equity investors in the mortgage space to come up with resolutions that banks and regular mortgage servers cannot. We have gotten so good at what we do that large, well-known mortgage servicers and mortgage investors have hired us as a third-party loss mitigation advisor on billions of dollars of their loan portfolios. Our strategy is truly Wall Street meets Main Street strategy. We do expect to expand into the commercial arena this next go around, and that is as a result of the stress that we're obviously seeing in commercial real estate as well. The key to our NPL purchase strategy, as I mentioned, is being a liquidity provider to whole loan investors and then acting as a Robin Hood to individual borrowers. If you are an investor or owner of a loan, and that the value, the net present value of that loan is derived directly from whether or not it's performing. So when a bank or a large financial institution stops taking payments and the loan goes sub-performing, NPL, or delinquent in some way, it becomes a costly endeavor to recoup that original investment, either through foreclosure or getting the loan reperforming. It takes a lot of man hours, and banks then end up marking to market the value of those loans. And in many cases, they don't see any value whatsoever. You and I know that if I hold the first lien mortgage on a house, that ultimately that underlying collateral has value, and that's where we come in. We look for the underlying value of the collateral behind these loans, and then we pay a percentage of that value as our offer price on the loan. So we're buying these loans at a discount to their face value. I want to get right to our presentation today. Andy Walden was kind enough to give us some time this morning. He is the chief economist for Black Knight Financial Services. For those of you that don't know Black Knight, they are the largest MSP provider of in the residential mortgage market here in America. MSP is the mortgage servicing platform. It's what all of our loan servers use to aggregate every piece of data on a mortgage. So your payment history, your documents, your communications with your servicer, the balances of your escrows, keeping track of what you owe in insurance and taxes. All of that data is held in secure servers that Black Knight controls. And therefore, the data we're going to see today comes directly out of those systems. And it's really, we're at the the primary point of information. So without further ado, Andy, thank you for being here. Take it away. Tell us what's going on in our market.
All right, thanks, Bill. Appreciate it. And Bill, quick check. Can you see my screen that I'm sharing here?
Yes, you took over. It's perfect, I think.
All right, perfect. Yeah, so as Bill mentioned, so Black Knight has historically collected monthly mortgage performance data, and we've done that clear back into the 80s, right? So we can look at mortgage performance through the decades. We'll share some of that information today. As Bill also mentioned, we have the MSP platform that services roughly 2/3 of all active mortgages. And one thing that's come out of the pandemic is a need for extremely timely information. And we'll kind of look at how quickly everything has progressed following the COVID pandemic. One thing we've done at Black Knight is we've started a daily direct feed from MSP. So we can pull mortgage performance data, pull payment activity, pull prepayment activity, pull forbearance activity on a daily basis, and really keep track of what's going on in the mortgage market, both in terms of delinquencies and in terms of forbearances in almost real time. So we'll share some of that data as we go through the presentation here today as well. I wanted to kick off with just a look here. We're looking at delinquency rates on the left side. On the right side, we have it broken down by individual delinquency buckets. So 30 days delinquent, 60 days delinquent, 90+ days delinquent as well. If we look over on the left side, I think a couple different storylines emerge. One is that in the early parts of 2020, right, back before the pandemic, we were seeing record low levels of delinquency, right? So in January of this year, the overall delinquency rate on first lien mortgages was at 3.2%. It was the lowest level on record. We can obviously see the impact there as we get into April, May, June, July, and the impacts of the COVID pandemic. And we can also give that a little bit of historic context by looking at what happened in the Great Recession. So looking over the last couple of months, we see that we went from that 3.2% delinquency rate in January. We saw that jump all the way to 7.8%. So what that tells me is about 4.5%, 4.5 to 5% of all first lien mortgage holders became delinquent really in the first few months of the COVID pandemic. And then we've started to see a little bit of improvement over the last couple of months. I think it's interesting to put it in comparison to the Great Recession, both in terms of magnitude. We haven't seen quite that level of delinquency rates overall, but the speed has been much, much faster. In fact, 10+ times faster in terms of the overall run-up in delinquency rates. It took about 2.5 years to go from the beginning of the Great Recession to those peak delinquency rates in kind of late 2009. During the COVID pandemic, it really only took 2 months. You saw the first inflow of delinquencies from COVID happened in April. By May, you had seen those delinquency rates peak out, and then in June and July, we've started to see them improve a little bit. On the right side, I think there's a couple interesting underlying stories there as well. You're looking at overall delinquency rate breakdowns. Again, you can kind of see that first wave of 30-day delinquencies hit the market in April of this year and then become more seasoned. Over the last couple of months, the storyline has really been those rising 90-day delinquencies or severe delinquencies. Obviously, it makes sense, right? You see that the first wave of early stage delinquencies hit in April, May, June. June's the timeline that they became 90 days delinquent. And as we sit at the end of July, about 1.8 million severely delinquent loans ahead of where we were before the pandemic. So roughly speaking, about 1.8 million seriously delinquent or defaulted mortgages right now as a result of COVID-19. The other thing that catches my eye when looking at that right chart is those 30-day delinquencies. And really what you see, if you follow the 30-day delinquencies, you see that huge spike in April. That's when the bulk of inflow took place. But then over the last couple of months, they've come down. And as of July, 30-day delinquencies were actually lower than where they were before the pandemic. And we're actually in July seeing the lowest number or the lowest volume of single month delinquencies that we've seen on record. And so it kind of tells the story that April and May were the inflow months, right? You saw the COVID pandemic hit. The bulk of inflow really took place in a 2-month span. Those loans that became delinquent are becoming more and more aged, right? They're rolling to 90, 120, 150 days past due, missing their 4th or 5th payment. But in terms of inflow, the spigot has really, by and large, shut off, and your single month delinquencies have normalized relatively quickly, which I think is an interesting part of the conversation. The question obviously is where do we go from here? What does the recovery look like? How many of those 1.8 million borrowers will get back to performing on their loans? And there's really a couple different ways to look at it. You hear time and time again that there is no corollary to what we're seeing in the market right now, and that's absolutely true. We're in kind of this weird mix between kind of a natural disaster type event and a recession type event, right? And so I think what we'll see in terms of recovery will be somewhat of a middle ground, right? And so here we've kind of put a trend line of what we're seeing with COVID-related delinquencies next to the most recent and kind of biggest natural disaster events that we've seen over the last decade, which was that 2017 hurricane season. And what you see overall, if you ignore this dark blue COVID trend line here and you just look at the hurricane impact on mortgage delinquencies and recovery timeline, what you see is the shape of that run up in recovery. If I back up and look at the Great Recession, the shape of that run up in recovery is almost identical. It's just a difference in speed, right? Here it's taking place, your run up takes place in 2 months. Again, with those hurricane type events, your recovery takes place in about 12 months in terms of overall delinquency rates. When you look at the Great Recession, it was about a 2.5-year run up and about a 7-year recovery. Shapes the same timing and length of recovery noticeably different. So that's one thing that I would point out there. The second is that when you look at the COVID pandemic and the magnitude, right, the per capita impact on overall delinquencies, what we see is that roughly, as I mentioned earlier, 4.5% of all mortgages in the U.S. roughly have become delinquent as a result of the COVID pandemic. Somewhat similar to what we saw in the 2017 hurricane season, right? If you look at those FEMA declared disaster areas, those hurricane affected counties, about 5.5% of those specific borrowers became delinquent. And your peak happened at the same time. Peak following those hurricane events, 2 months following the actual impact or the landfall of those hurricanes is when delinquencies peaked out. If you put the onset of the COVID pandemic in the US at March, and then kind of fast forward that 2 months, April, May is when we saw delinquencies peak out in the US housing market as well. So kind of similar overall peaks and similar timing of the impact so far. And then you can see that we've started to recover a little bit, somewhat similar to the recovery trajectory of a hurricane so far. Now, this could flatten out a little bit. Again, what we'll likely see is probably somewhere in the middle of a hurricane type recovery and a recession type recovery, but so far kind of recovering along those same timeframes. 90-day delinquencies, again, similar storyline. Typically following a natural disaster type event, it's 3 to 4 months after the hurricane makes landfall that you see those 90-day delinquencies peak. As of July, we're 4 months post impact, quote unquote, of COVID. And you can see that the overall, again, magnitude there, or the overall per capita impact of COVID has fallen very closely with those hurricanes so far. Now, we have started to get into some of the August month-end data over the last couple of weeks. We'll start sharing that with the market probably next week with our first look release. Early numbers are suggesting this may creep up a little bit more. We may not peak out there in month 4, but what it does suggest is, I mean, you can see how sharp that run-up is. If you look at these hurricanes, I mean, if you ignore the hurricanes, it looks like you're going to continue to see these 90-day delinquencies rise pretty significantly. What these hurricane trend lines suggest is we may be closer to that peak of 90-day delinquencies than what you may expect. We could kind of cap out somewhere in that 1.8 to 2 million loan range, and especially when you look at those early stage delinquencies that we saw on the previous slide, and the fact that they've normalized, that also suggests that we could be nearing the peak of 90-day delinquencies as well. Obviously, the question again is, as I mentioned, 1.8 million additional severely delinquent loans compared to where we entered the year. What does that look like? And we know a lot of these loans are in forbearance. We'll get into some forbearance numbers here in a little bit. What does that recovery look like, and what share of those loans end up in foreclosure? And one thing that we've done to kind of put some numbers around that is we've looked back at those historical hurricane events, right? So in 2017, you can kind of see our severe delinquency run up in those hurricane affected areas, about 140,000 severely delinquent loans that came from Hurricanes Harvey and Irma in 2017. And we tracked those specific loans over the next 2.5 years to see how those loans performed and what share of those loans were eventually lost to foreclosure. We did the same thing back in 2005 following Hurricane Katrina as well. Hurricane Katrina had a little bit higher per capita impact, right? The share of folks in affected areas that became delinquent were higher, but the recovery rates, right, and the end foreclosure rates were relatively similar following Katrina as well. All right, so on the right side here, we're looking at those 142,000 loans that became severely delinquent following those hurricane events. And we're looking 2.5 years later, entering 2020, where were those loans? And what we see is pretty surprising. Of the 142,000 loans that became severely delinquent following those hurricanes, only 3 to 4% actually ended up in foreclosure, in either active foreclosure or had been lost to foreclosure sale. That's a pretty strong recovery rate, right? 2.5 years after those natural disasters hit, you only had 3 to 4% of those loans that were actually lost to foreclosure. If we look at that in comparison to the COVID pandemic, that 1.8 million, call it a 5% failure rate, right? If 5% of those loans end up in foreclosure, you're talking about 90,000 foreclosures that would result from COVID, which is a 30 to 40% increase. Entering the year, we had about 250,000 active foreclosures. That's a 30 to 40% increase. But under that specific scenario, I think that's pretty optimistic as well, and somewhat of a limited impact. Now, again, I think that's probably conservative or a lower default rate than maybe we would expect to see from COVID for a number of different reasons, whether it's insurance payouts following natural disasters, whether it's kind of the larger recessionary effects that we're seeing from the COVID pandemic. But historically, following just simple natural disasters, your foreclosure rate has been relatively low on affected loans. I think it's also interesting to look at this right side here, right? So we gave ourselves a baseline scenario of loans that became 90 days delinquent at this same time, right? So in this 4-month window in other parts of the US that were not in natural disaster type areas, that didn't have the benefits of insurance payouts, didn't have FEMA funds going to them, right? So these are borrowers in all other parts of the US that became severely delinquent at this same time that did not receive those forbearance type plans. And when you look at that, you see that there's a 25 to 27% foreclosure rate among those loans, right? So I think this is kind of the lower end. This is a natural disaster type event. This is a traditional mortgage market. So you kind of see that there's a pretty big window, anywhere from 4 to 5% default rate up to 25, 27% default rate. If you saw a more recessionary type effect, you could see default rates or foreclosure rates rise even above that. So a lot of questions about where we could go from here. And even when you look at the historic results, you see some pretty wide windows on potential downstream impacts of loans that are severely delinquent right now. One benchmark that I would give you, so again, I keep going back to that 1.8 million number, 1.8 million severely delinquent loans right now. The benchmark number for me is right around 15%. Right? So if you saw a 15% foreclosure rate on those loans, it would double the foreclosure rate in the US. So again, 250,000 foreclosures entering the year. If you saw a 15% failure rate or a 15% foreclosure rate on those COVID-related delinquencies, it would give you about 250,000 additional foreclosures, or double the foreclosure rate from where we were before. If you saw a 30% failure rate, it would triple the foreclosure rate from where we were before. So a lot of, I mean, given how large that volume is, a large swath of, or a large disparity in what we potentially could see in the coming months and coming years. Here on our next slide, we're getting into some of that daily data that I was talking about earlier. So here on the left side, we're looking at the cumulative share of mortgage payments received on each day of the month. It really gives us some early insights into mortgage delinquency activity as the month unfolds. And really what we wanted to look at on this slide was, we know that those expanded unemployment benefits expired at the end of July. There were a lot of questions about how much support that's been giving to the mortgage and housing market. And could we see delinquency rates increase or spike after those expanded unemployment benefits were reduced or removed? And what we've seen so far is that payment data and early payment activity for August was actually pretty strong. It actually was a little bit stronger than what we saw in July. If we look at forbearance starts over on the right side, which would be another leading indicator for stress from the removal of those expanded unemployment benefits, we continue to see those taper off. In fact, the first couple of weeks of September, we we've seen the lowest level of inflow of new forbearance plans that we've seen since the COVID pandemic hit. So both in terms of mortgage payment activity, stress in terms of new delinquencies, and in terms of new forbearance plans, you're really not seeing any kind of impact from the reduction in expanded unemployment benefits. I also put a chart in here about geographic impacts. I know there are a lot of different regional investors across the market as well. So I really wanted to show how COVID has impacted the mortgage market across the US. Here on the left side, we have it mapped out. So your areas, what we're simply looking at here is the delinquency rate increase from February through July of 2020. So your areas in blue here have been more heavily impacted from the COVID impact, meaning that, or the COVID pandemic, meaning they've seen a larger delinquency rate increase than the national average. Areas in green have seen a lower than average impact from the COVID pandemic. And you can kind of clearly see the hot spots across the country. The Northeast, obviously New York and New York City were the epicenter of the COVID pandemic early on. You can see New York, New Jersey, areas of Connecticut, much higher than average delinquency rate increases. Florida certainly stands out here, Texas, inland California, and Nevada, some of the areas that are seeing the highest delinquency rate increases. Then you can see those green areas as well. Obviously the Midwest stands out here with the exception of Chicago, the Midwest by and large being lesser affected by the COVID pandemic in terms of delinquency and default activity than more coastal areas. The Rocky Mountain region, a little bit lesser impacted, Northwest. And San Francisco and San Jose are always interesting areas of the country, both in terms of the housing and mortgage markets. Obviously, we've seen what's happened with the tech industry, tech stock prices in recent months. And San Jose and San Francisco certainly stand out in comparison to the rest of California in being lesser impacted by the COVID impact or COVID pandemic. Now we're getting into some of those forbearance numbers. And again, we track these forbearance rates on a daily basis. We can kind of look at what's going on with inflow, outflow, active forbearance volumes. A couple things stand out to me, aside from just looking at those overall industry forbearance numbers. One is the kind of slow and steady recovery that we're seeing with stair-step improvements that happen at the end of the month. And so really, when you kind of look at these recovery rates, you kind of see slow improvement. You get to the end of June, you see a sharp drop in forbearance volume. Same goes for July. If I were to roll this forward another week, we saw about a 200,000 loan drop in forbearance cases over the last couple of weeks as well. So another stair step there at the end of August, and then very limited improvement throughout the month. And really the reason for that is in the middle of any month, there's really very little incentive for a homeowner to leave those forbearance plans unless you are taking advantage of a refinance, taking advantage of the record low rates in the market right now, and you're exiting that forbearance plan to either sell your home or refinance your mortgage. Really little incentive to leave those forbearance plans. And so that's really what you see. There's not a whole lot of movement in reported forbearance numbers really in the second or third week of the month. But then you get to the end of the month and you have those expirations that are set to take place. And so you'll see servicers revisit those loans at the end of each month. They'll extend the terms of those forbearances or remove those loans for forbearance. And that's really the last week of the month, first week of the following month is really when you see those improvements. All in, and these numbers that we're showing on screen here as of the end of August, if we rolled this forward to today, we're now down to about 3.7 million loans in forbearance. Our forbearance rate's down to about 7%. We have seen a little bit of improvement over the last couple of weeks. Another thing that stands out to me in terms of forbearance activity is really that September and October are going to be very telling months for the mortgage market in terms of success rates of forbearance plans overall, and in terms of what the mortgage market is going to look like towards the tail end of the year. And the reason that I say that, here on the right side, we're looking at scheduled expirations of those forbearance plans. And again, we're at about 3.7 million active forbearances in the market right now. 2 million of those, so more than half of active forbearances, are set to expire in September, meaning September is the last forborne payment. So over half of loans are set to be reviewed to either be removed from forbearance or to have that forbearance plan extended here towards the end of September, most likely happening kind of in the last week of the month there. So a significant volume there. The other thing about that September review, right, because those same subset of loans were reviewed for extension and removal back in June, right? So really what you see is that servicers set these up as 3-month plans. They were reviewed for the first time primarily in June. Some were removed. You can obviously see the difference in volume there. Some were removed, but the remainder were extended for another 3 months. So this is the second review that these loans are going through primarily. And the other thing is when you look at the structure of the CARES plan overall, it states that borrowers are allowed 6 months of forbearance with another 6 months upon request. Right? So a lot of these servicers are going to have to request that additional 6-month extension. So you could see a higher rate of removal versus extension this time around than what we saw the first time around. But certainly something that we'll be keeping an eye on. Right? So over half of forbearance plans set to be reviewed here in the month of September for extension or removal. Another over 1 million set to be reviewed in October. So the vast majority of active forbearance plans will be reviewed for extension or removal here at the end of September and end of October, and we'll get a little better view of what the market's going to look like as we get through those 2-month timeframes. Next slide here, we're looking at ever in forbearance versus active forbearance, right? And what that shows us is that there have now been actually 6 million borrowers that have entered into an active forbearance plan at some point in time. We actually peaked out at about 4.7 million forbearance cases. So that's the highest the reported active number has ever been. That's probably the highest number that most folks have seen, but there have actually been 6 million borrowers that have entered into a forbearance plan at some point over the last 5 to 6 months. 34%, so over a third of those loans are no longer in forbearance. And we see some positive and some negative when we start to look at the results there. The good news is that 30% of loans that have ever been in a COVID forbearance plan are either paid off or they're reperforming on those loans, right? So 1.5 million are now back to performing on those mortgages. Another 4%, a little bit lower than what I would expect to see given how low interest rates are, but another 4% have either refinanced their loan or paid off their mortgage in whole, as a whole. So 30% of ever COVID forbearance are either performing or paid off. This is the more concerning population here, about 250,000 loans that were in a COVID-related forbearance plan that are now no longer in an active plan, but are still past due on their mortgage. Obviously some work to do on the servicer front, maybe some opportunity there from an NPL standpoint as well. And then lastly here, and I think this will be a point of discussion here in a little bit, it's probably something that I should have mentioned earlier as well. When you see delinquencies reported in the market, a subset of those delinquent loans, in fact, the majority of those delinquent loans are actually in forbearance plans right now. And when we report delinquencies as Black Knight, and I think most of the other folks that report delinquency numbers in the market as well, are actually reporting loans in forbearance as delinquent if they are not continuing to make mortgage payments. The reason that we do that is we track it by next payment due date, right? So we want to see overall stress in the mortgage market. We want to be able to kind of track the overlap and underlap between forbearance and delinquency. And so that's what we're looking at in the Venn diagram on the left side. You can see our larger rectangle box, which shows the loans in forbearance as of July month end. Right? So at that point in time, there were 4 million. We're now down to 3.7 million. But as of July month end, there were about 4 million loans in forbearance. Only about 2.8 million of those were actually past due. So you had about 25 to 30% of loans in forbearance that continue to make mortgage payments that aren't delinquent. At that same time, you have 3.9 million loans that were past due on their mortgage. You can see we've separated them out from borrowers that have become delinquent over the last few months. There are 2.7 million of those versus 1.2 million pre-COVID delinquencies. You can see that the forbearance take-up rate on those subsets are different as well. Borrowers that have become delinquent recently, about 85% of those folks have entered into a forbearance plan. Of loans that were pre-COVID delinquencies, only about a 45% take-up rate there, right? So some noticeable differentiations. Obviously, when we start to look at foreclosure risk, and I'm interested to see Harris's opinions on this here in a little bit and what he has in terms of insights in upcoming foreclosure activity. When you look at foreclosure risk, these gray areas really are the loans at risk of near-term foreclosure if and when those moratoriums are lifted. These are borrowers that aren't protected by those forbearance plans and could be subject to near-term default and near-term foreclosure if and when those moratoriums are lifted. These remaining loans are really in those forbearance plans primarily until, assuming a 12-month extension, right? They go to the full 12 months. They wouldn't be at risk of default or foreclosure, assuming a failure until March or April of next year. So with all that being said, I think I'll pause there and we can kind of open it up to the panel for more discussion.
Wow, that is some very interesting data there, Andy. I appreciate the updates. When do you expect August data that you mentioned you've been reviewing now for a few weeks? When will your first report become available to the public, and how should we be watching for that?
Yeah, it should. So we report something called our first look release. So we get our August data in. It should be released to the market either today or tomorrow. And then we create extrapolation factors to really get a good market sizing estimate there. Should be released kind of middle of next week is when folks should look for those August numbers to come out.
And I assume that the news stations, that's where they pick up the reports that kind of go out from your mortgage monitor.
Right, yeah.
Okay, great. If you want to unshare your screen for a few minutes, we'll bring the panel in. Gentlemen, welcome. We've got Harris Howard, Ari Meltzer, Kai Tsukiyama. Say hello.
Morning, everybody.
Great. I want to review a couple of key points here, and then we'll get into questions. The 250,000 loans that have already come out of forbearance, but are now delinquent. Now, when you do kind of I was just doing some rough numbers as Andy was speaking, just that's like 60 billion with a B, over $60 billion worth of debt. That is just that first phase of resi mortgages that are now in some kind of delinquency and whatnot. And then if you look at the forbearance, you look at the volumes of the forbearance debt, it's 10 times that. So it's closer to 600 billion. So there's a lot of debt out there in terms of dollar volumes that is obviously pretty important data to watch. I want to start with you, Kai. Kai, you're the portfolio manager. You look at these numbers a lot. You talk to the servicers on a daily basis. One of the things that caught my eye was that first slide from Andy when he talks about, the serious delinquencies are still on the uptick. And from what I heard between the lines, August may not be leveling off as much as we had hoped, maybe take a little bit longer. Is that right, Andy? In that sense. And so Kai, yet at the same time, you've got these 30-day delinquencies at the lowest level in 20 years. How does that make sense to you? Maybe there's questions in that from you, or what are your thoughts on that, Kai?
I guess, Andy, I'm not sure how your numbers are, reported. Does that include people that are on forbearances making partial payments?
They would have to be a full payment. If they didn't make the full payment, then they would be considered delinquent.
Okay.
But yes, it would include forbearances.
Got it. So forbearances, even with a actual forbearance payment that's being made, that's rolling the due date forward.
If the forbearance payment rolled the due date forward, it would not be considered 30 days delinquent. Yep.
Okay, so I think it may be. I think part of it may be an accounting thing that's going on with the servicers. I know that some of the servicers are accepting partial payments, rolling it forward, and then putting the arrears automatically on the back. So when they come out of it, they're not looking at a 6 month ramp up of payments that they're going to have to come up with. I think it comes back to the climate of this one versus the last one is going to be very different in the sense that when they come out of this, it's going to be a single payment rather than 6 payments they need to make to reinstate the loan and get it back on track. What we're seeing with our servicer, I think that there's a combination of a few things. Some people are back at work, so they're able to come back in and start making payments, which would make sense on why things are, kind of getting back to where they were prior to COVID. Not only that, but the real estate market as a whole seems to be moving very quickly with low inventory and, a lot of buyers coming to market with all-time low rates. We're seeing a turnaround time of a very low days on market that we haven't seen for even pre-COVID. which is pretty amazing. So, I mean, I
Right.
think money has a lot to do with
So
it.
you're kind of thinking that the appetite on the back end to absorb whatever foreclosures may be coming down the pipe is so great that it could look a lot different than it did a decade ago. In other words, is what you're saying. Very,
Definitely.
very. It's interesting, Andy, that that there is kind of this question in the numbers, and I've done a lot more in recent years to kind of dig a little deeper. Every time I get a piece of news or some data, I always try to figure out, are they slanting this data in a certain way to make it look good or bad? What advice do you have for us, Andy, as consumers of this data? What are the most important factors for us to keep an eye on in the next 60 days? I know that with forbearances coming to an end on a bulk of those that are in forbearance, what's important for us to look at?
Yeah, and I would say a couple things. When we're talking about scrutinizing data, I think that's key, right? And some of those questions have already been asked. How are you calculating this? What's included? I think that's certainly important to know. If I switch to the second part of the question and what numbers are important to look at going forward, here's the numbers that I'll be looking at. I'll be looking at those 90-day delinquencies over the next couple of months to see if and when they start to curve and turn. I'll be looking at forbearance rates, especially around the end of September, the last week of September, first week of October, and then again in late October, early November, to see what those look like and what level improvement we see at that point in time. We know that there are a quarter of loans in forbearance that continue to remit at least partial, if not full payments. And so you could see a number of those borrowers not request that additional 6 months and come out of forbearance. So those are a few of the key numbers, along with those 30-day delinquencies, because I think there's somewhat of a concern of a second wave of delinquencies coming in. Keep an eye on those current to 30 rolls and 30-day delinquent inventory overall to see if we do see any kind of secondary effect in the mortgage market, or if we're simply dealing with those delinquencies that primarily came in April and May.
Very good. Interesting. Okay. Harris, let's turn to you. Welcome. A few weeks ago, we spoke a little bit about government intervention in this whole situation. But maybe you can, with fresh eyes, give us some high-level perspective. What are you seeing in the courts in terms of the reaction to what we expect to be a new wave of foreclosures and evictions? What are you seeing on the ground every day? And is it congruent? Is it court by court? Is it state by state? Is it area, district by district? Talk about where the courts are at these days.
Yeah, thanks, Bill. First, Andy, I appreciate your presentation. I learned a lot. I think the information provided by the data is very helpful to me and to everyone that's joining. In terms of the courts, I don't think the courts, I practice just in Florida, at least in Florida, I don't think the courts have really seen the full brunt of what this COVID pandemic has caused, because a lot of the government loans quickly went on hold, moratorium hold, and remain on hold. So not only did some of the pending actions get placed on hold, but there were no new actions. So while we talk about all of these defaults, 30 days, 120 days, forbearances that are expiring and then terminating, those haven't resulted very much in any court activity. My book of business and my practice is mostly based on private investors like yourself, Bill. And I can tell you, we've seen in Florida, the moratorium on foreclosures was lifted at the end of July. So starting August 1st, we were able to proceed with litigation on defaulted paper starting August 1st. And we've had a big influx of activity since then. And we have not seen any delays really in terms of getting hearings or moving our cases along. The delay that we have seen is judges rightfully being somewhat sympathetic to some of the timelines that are out of our control in terms of sale dates and pushing out eviction putouts. And then to further answer your question is, some of those variables are judge by judge and county by county across the state of Florida, where Judge A may be more sympathetic than Judge B in terms of extending a sale date or an eviction put out.
Interesting. If you don't mind, I want to follow up on that a little bit because we may not get to all our questions, but I think this one for you is very important, Harris. Talk about your liability or what your role as an attorney on a file that's in default. What are your considerations given the new circumstances of government moratoriums and the whole COVID pandemic? For example, I know that you take your orders from communications through Black Knight's system, the LPS system, and the servicers are telling you to move forward or pause an action. Is there any responsibility on your end? What if a servicer just assumes that a loan's not government insured and they mistakenly, not to say that this is happening, but just mistakenly tell you to start foreclosure proceedings? What responsibility do you have as the attorney on the case to verify whether a loan that you want to pursue legal action on is possibly subject to either the federal, state, or local moratorium?
Yep. So the converse of that is true also. So while we may get a loan referred to us that shouldn't be referred, sometimes the loan goes on hold that shouldn't be put on hold. In both instances, we're very mindful of the paper that we're seeking to foreclose upon. And if we have any question, we will reach out directly to the servicer and figure out what the answer is. And equally as important, as I mentioned, my office is direct to most of the investors that we represent. So oftentimes we will go directly to the investor and say, look, here's the situation. And this is true for not only referrals or files going on hold, but settlement discussions or strategy sessions regarding how we're going to litigate or how we're going to settle the case. We'll go direct to the investor and present the plan and the options and come to a decision and move forward accordingly.
Interesting. I'm thinking on the fly here. Do you see any kind of move on the parts of borrowers or their representatives to take advantage of the situation? Are you seeing a trend in that direction that maybe they don't need to get into settlement conversations with you at this point because they know that they've got this moratorium or they've got something protecting them at least through the end of the year?
So in Florida, again, and I represent private investors as opposed to government-backed loans, there isn't really that backdrop for these borrowers anymore in my private mortgage world, because the Florida governor issued an order basically lifting the moratorium unless the default is directly related to COVID and has directly adversely impacted the borrower. That burden is on the borrower to prove that adverse impact. And none of my files right now are COVID-related defaults. However, there's always creative foreclosure defense attorneys that are trying to delay the case or raise issues with the judges to either win their case or delay the case. And that's not going to go away. It's going to certainly increase with the ability of them to raise defaults or COVID-related issues.
That's good info. Ari, let me switch to you. You own several multifamily properties, manage several more, as well as some mixed use. I know you're into a college property. You're into regular residential properties. What are you seeing either across the board on your properties or in the marketplace of other commercial multifamily landlords? Is there any specific asset classes that you're seeing rent collections reduced, or what are you seeing?
So obviously, like anybody else, when the crisis first hit, we saw some delinquencies, but we actually recovered pretty quickly here in Florida. I would say that's been the consensus across the board. And currently we have, if I tell you amongst about 1,000 units that I'm involved in almost on a day-to-day basis, less than a handful of stragglers, I would say. I think initially, obviously before the stimulus came, people didn't know what to do. There was that shock of the people that lost their jobs. But as Florida has opened back up a bit, I think some of the people that kind of fell off the wagon, most of them either were able to attain, whether it's other jobs or the stimulus did help. But But one thing I can say, and I think it'll pretty much affect everything we're speaking about here, is I believe if there is another delay, which it seems like there is in getting another stimulus out, that can start to weigh on everybody. And I guess time will tell. That being said, being in Florida, as everybody's kind of alluded to, the markets remain strong in single family and in rentals in general. People that are able, that want to, whether if they can work remotely, which most people have made arrangements to do so, they're coming down to Florida. So we've actually seen a big spike in demand through my associates and what I've seen in people that have relocated and are happy to
Yeah. It's
kind of
interesting
make do
that
with
you
the South Florida
mentioned that
lifestyle.
because, you mentioned that. It's interesting you mentioned Florida because it is a little bit of an anomaly. I've heard from people in the Northeast that I talk to, everybody knows somebody or they themselves is relocating out of the dense urban cities for as long as they can until their work says you have to come back. But what I thought was going to be a very brief 6-month to 12-month period, I think the expectation amongst a lot of mid-level professionals and people from the major metros of the Northeast is that this is going to go on longer than necessary. Not necessarily that COVID's going to be an existential threat the way it is today forever, but that everyone's patterns have kind of changed, and what we thought would be maybe a quicker turnaround may not be as quick. I love the fact, Andy, that you reference, you kind of try to look for ways to equate what's going on in this once in a generational situation to what we've experienced so far. So the equation to a hurricane, first of all, plays well for the guys in Florida, and and second of all, it makes a lot of sense. It's obviously very similar trends, following a natural disaster. The difference, of course, here seems to be in the numbers, right? I mean, a hurricane might affect 2 or 3 states. We're talking about a nationwide across the board effect. So I assume the numbers are just voluminous comparative, even though the percentages mirror the hurricanes, right?
Yeah, that's right. So if you look at the overall count of delinquencies, I think it was 142,000 for Harvey and Irma in 2017. We're talking about 13 times that impact when you start to look at COVID and just the number of delinquencies. So per capita, similar effects, but instead of, as you mentioned, instead of affecting 1 or 2 states, you're affecting the entire country.
Right. And I think that one of the inefficiencies that our firm was luckily be able to take advantage of in the last cycle was mortgage servicing, right? So mortgage servicers, asset managers represent, at these loan servicers are managing maybe 1,000 loans per person, whereas a firm like mine might invest $100 million and buy 400 or 500 loans and have our entire firm managing that number. Kai, with this in mind, with these numbers of delinquencies, I mean, just the 250,000 loans that came out of forbearance that are already DQ, and what may be on the horizon was the 2 million more due to expire in the next 60 days. Kai, what do you think loan servicers are facing? Are we going to see similar? It just seemed like the servicers kind of threw their hands up and went crazy for a little while last go around. What are you expecting in the next couple of months, Kai?
And I think that they're better prepared for it this time around, or at least that's the hope. I think we learned a lot from the last go around. But that said, it really does depend on the influx. And, as Andy mentioned, some of these forbearances are going to be extended. Some of them, they may be removed. The ones that are extended, and it depends on what happens as far as government intervention as well. We have moratoriums on evictions through December on a lot of the products. So I think that it really just depends on how it's rolled out. For things like, for people like us with a privately held mortgage, we're finding that a lot hasn't changed in the sense that we're still able to move foreclosures forward. We've had multiple sales in different states throughout the country. So there isn't a lot holding us back there. So hopefully, if the bulk of the product that's being serviced by an independent servicer is not government insured, it may not be too bad of a hit at one time. So that's the hope at this point.
Interesting. I don't know, Andy, if this is something you ever have access to. Black Knight is obviously a large organization. You're our MSP provider for all of our servicers. But do you get to hear any chatter from the servicers? Are there any challenges that you're hearing from your clients being our loan servicers? Are you hearing of any challenges that are different with COVID comparative to the others?
Yeah, I mean, Kai touched on the fact of, well, so let me start here. So I think the biggest challenges are staffing, right? So you went from a record low rate environment or a record low default environment to one of the largest increases that we've ever seen in terms of monthly increases. It's happening at the same time that folks are transitioning to a work from home. And so I think the biggest piece of it has been trying to deal with everything that's going on at the same time that you're transitioning all of your folks to work from home. So I think that was a big portion of what was going on. I mentioned that there's a lot of tools in the tool belt from the last go around. I think that's true. We are a lot better prepared to deal with this influx. A lot of people in the industry that are dealing with it today were there 10 years ago during the Great Recession. So I think it's kind of second nature. A lot of the loss mitigation strategies, a lot of the programs are somewhat similar. But I think a lot of it's been staffing, going from low staffing volumes in a default center to high staffing volumes at the same time you're transitioning. And then obviously, anytime you're rolling out new programs at a high volume, there's challenges there. But I think that's been most of it. I think the shock wave of a significant increase of default activity hasn't been as much as just the staffing challenges.
Right. That makes sense. You're an economist, so I love talking to economists and hearing you opine. So, we don't have much time left, unfortunately, but I want to hear from you, Andy, one more time. In 2008, after the financial crisis was about literally 12 years ago, this month, was when Congress had to step up and increase the Troubled Asset Relief Protection Plan. And there was so much infighting, and ultimately a $700 billion checkbook was handed over to help prop up financial markets. At the time, you had people saying it was too much, you had people saying it was too little. We won't get into the politics of that. But then again, come this spring, the government came in and opened up the checkbook again with PPP and these forbearance and writing checks to people. What is, from your perspective, and we've been allocated several trillion, so probably 3 times the number that at least of what we had in TARP. And it was unprecedented 12 years ago. It was unprecedented this spring. There's a lot of people, you heard Ari say, that we probably need another stimulus this fall just to ensure to hold the floor. What is your thoughts on all this government intervention? What is the potential long-term effects, and what are your concerns?
Yeah, and so let me start with what's been done right. I think a lot of that money that's been spent so far has been put into bond buying programs. So the difference between the 2008 Great Recession and what we're seeing here today is hopefully this is dealing with short-term loss of income, where 2008 was dealing with traditional poor credit quality loans that, regardless of whether you put a forbearance program in place and gave them 12 months to get back on track, if you had an option arm that was adjusting upwards and you couldn't afford it, or you had a stated income loan that you couldn't afford, no amount of short-term assistance was going to get you back on track in 2008. And then you had that coupled with falling home prices and walk-away risk at the same time. If you look at the market today, we have record levels of equity out there in the market right now. We have extremely strong credit quality, and we have what is hoped to be a short-term loss of income. So the strategy has been very different around the COVID pandemic versus 2008 because they're completely different in their nature. All right, so that's one thing. The other thing that I would mention, I really like the bond buying program that's pulled down interest rates for one key reason, right? And it's caused a wave of refinance activity that's helped mortgage originators and things of that nature. But the second thing that it's done is if you look at home prices, one of the things that happened in 2008 was you had these falling home prices and you had this snowball effect of people defaulting, walking away, they're selling their homes into default or foreclosure, and it pulled home prices down more. What we've seen is interest rates fall, and it's really supported the housing market. So whereas if you would have talked to economists 4 months ago, they thought there was a heavy risk of falling home prices over the next 12 months. You've seen relatively strong home prices, which reduces that snowball effect in the market. Right? And they've also put into place forbearance programs and all these other things that help with that short-term loss. And we'll see if those are extended and how those play out over the next few months. But I think there are a couple kind of strategic things that have really helped us along the way. One is that pullback of interest rates that have really been beneficial, not only to mortgage lenders, but really when you look at default risk, it's been beneficial in that as well.
Yeah, that is interesting, and I thought your comment about with interest rates being so low, you'd expect more refis. I think that's kind of a sign that maybe there's an affordability job issue that is kind of waiting in the wings. That could be, you know, the straw, so to speak. Well, guys, I really appreciate it. We've had a great live audience. We had over 50 members. No questions came in live that are that we need to address here today. If anyone has any further questions, they can reach out to any of our participants directly. We appreciate you all for being here, Kai, Andy, Harris, Ari, and thank you for your time today. Everyone's contact emails are on the video here now. And if you'd like a free copy of my book about the NPL business, we've left a web page up where you can enter your information. We'll get you out a free copy. Gentlemen, thanks so much for your time, and let's do it again.
Thanks, Bill.
Yeah.
Well, Bill, Kai, Harris, and Andy, thank you so much for being able to join us for today's presentation, where we took a look at the rising defaults create opportunity and the opportunities created for distressed debt buyers. Unfortunately, that is all the time we have for today. Please be sure to visit Spurs Capital's website at spurscapital.com, and please be sure to take down everyone's contact information that Bill provided. And please feel free to follow up with them directly with any questions you may have. Again, you'll find a copy of today's episode at opalgroup.net under the on-demand section. You'll also be able to get more information on upcoming Opal Group virtual conferences as well. And please keep in mind, Bill and Spurs Capital will be returning for 2 additional episodes. The first one coming on Tuesday, October 27th, and the second will be coming in on Tuesday, December 8th. So please keep that in mind. Also put that on your calendar. Listeners, thank you so much for being able to join us today, and we look forward to having you at the next one. Thank you so much, guys. Take care.